Hey everybody, Tyler and I are going to revisit one of my favorite stocks to talk about, not necessarily invest in, and that is Opendoor. Before we do, please take a minute, click subscribe to my channel, and check out the message you see in your screen. It's from our sponsor, The Motley Fool, and it's the best way to support this work we're doing. So, Opendoor is kind of entering a new phase. It recently appointed a new CEO. It was the company's former CFO. Her name's Carrie Wheeler. She took the place of Eric Wu, who was the company's co-founder, and she's been an investment finance executive for over 20 years. Pretty interesting choice for the role. And not only that, the real estate market is slowly showing signs of turning around. It's been kind of dampened so far this year by weather headwinds, especially. People can't get out to look for houses when there's 3 feet of snow on the ground. But we're seeing signs that it might be turning around. Mortgage rates are significantly down. And iBuying is built to thrive in a market that is rising and very active. The whole business model is predicated on two main things. One, most obviously, being able to sell a home for as much or more than you paid for it after your costs. And number two, to not hold on to it forever. Uh, you know, these companies borrow money to buy homes. If you have to hold on to it for a year, there goes your profit margin right there, even if you sell it for a good price. So, Tyler, in we'll start with you can start with either the CEO or the market conditions, but what do you think about Opendoor as we kind of get into 2024 and the peak spring housing market?
Sure. Well, there's two things I really am curious about in terms of the business, and this is where kind of I think you and I have been talking about this because it was actually quite surprising. Like I didn't, I went through Opendoor's SEC filings, and that's how I found out that the founder had left. There wasn't a press release from the company or anything like that. It was just like unceremoniously a couple days ago. It was like effective January 1. He had stepped down as the CEO, but was going to remain with the board as like chief of marketing or something like that. And then we just got an SEC filing that said he's leaving effective January 1. So I was really surprised by this and kind of was like, huh. So I just started digging in a little bit more, trying to figure out what happens from here. As you said, Carrie, new CEO, finance background, spent a lot of time at, I think it was TPG Global. They're a alternative private investment kind of group. One of those companies that has, you know, over time, like a lot of other private and alternatives have been like buying up single family housing and renting it out and things like that. One of those kind of businesses. So, there's some experience there. I that's really to me like the new CEO thing's a little bit of an incomplete. When you have the founder CEO thing, you kind of have this visionary, or not visionary, but somebody with a grand vision for what they want this business that they started to be. And when you pass it on to somebody else, especially in such an abrupt manner, you do have to wonder what that transition is going to look like. One thing I have noted, and I'm sure you've noticed it as well, is that it's been pretty quiet at Opendoor. We haven't seen a lot of press releases. We haven't seen a lot of announcements of things that are happening, launches and things like that, which is quite opposite from what we saw previously with Opendoor. Lots of blog posts, lots of press releases, things like that. So it's a very, I would say almost like private investor kind of approach that like somebody that previously had handled alternative assets is going to do. Is like, we're just going to be quiet, we're going to do our jobs, and we're going to try to make a return out of this. So like I said, I think this is an incomplete. I don't know what any of this means, but I was fascinated by the abrupt change, and it didn't seem to have changed much in terms of like the thinking on Opendoor. I haven't seen a lot of like big investment thesis changes or like analyst changes because they got a new CEO, which I found a little bizarre.
Yeah, I mean, the stock has performed really well in the past year or so. It's worth mentioning that the stock's roughly tripled in the past year. And I mean, in simple terms, it's because things didn't turn out as bad as the market thought it would. They were able to kind of pivot to a new profitable book of business. Everything they acquired pretty much since mid 2022 has been profitable, at least more so than what they acquired before when the market was kind of going all over the place. And my biggest question, the reason I don't own the stock, is did they dig themselves kind of too much of a hole when the market was taking a turn. Just looking at the debt and capital numbers. Yes, and whenever I mention this, everyone always says, "Well, they have $8.5 billion of borrowing capacity." Yes, but they don't need to use all that. That's a bad thing when the interest rate environment's so high. If you need to keep borrowing and borrowing and borrowing, they have $2.8 billion of debt right now, and only $1.3 billion of inventory on the books. That's what I mean by they've dug themselves kind of a hole. Because of that, they have to keep $1.5 billion or so of cash on their balance sheet to be able to cover, all their obligations, or else they're insolvent. And that's really my question right now: is if even let's say the real estate market's fantastic for the next 2 or 3 years, is that enough for them to really dig themselves out of that debt hole and get it to more of a sustainable level?
Yeah, and to that point, and this is the key point I want to be watching too, is how fast can they turn over their inventory? Because, as you said, they had this legacy book that they've been trying to get down, and the new book that they have is profitable. But one of the interesting things that they actually mentioned in their most recent investor presentation is they kind of broke down their margins and like how we become profitable. And part of what they even mentioned in it was how fast they turn inventory, because that's going to impact their interest charges, basically how much because they have to take out short-term financing to buy the home or take out a short-term mortgage. And so one of the things they mentioned is like, as long as we keep our inventory turns above 2.5% or 2.5 times, excuse me. So if we turn over our entire inventory of homes 2.5 times every year, that's a speed, it's fast enough that we can recover our interest coverage, our interest payments, and make a profit at the end of the day. As of right now, as of the most recent quarter, their inventory turnover rate was 2.3 times. So they were below that profitability level. And they gave a range in their presentation of 2.3 up to 5, saying like, if we get up to 5, we're going to be very profitable. But they're below that minimum level. And so I, that's something I think will be a key thing to watch in 2024, is how quickly they're turning over their inventory, because it's a drastic impact on how profitable this company is. I know we talk about like it's a thin margin business, but if you sell one home, it's a lot of cash. But if you incrementally change that margin ever so slightly on a thin margin business, it goes from a $20,000 profit to a $5,000 profit really, really fast. So that is the biggest thing that I want to see in the coming year. And I wonder how that's going to happen, because like you said, this business works really well in a fast environment, right? Like where homes are being sold a lot. There's a lot of inventory. There's a lot of choice, kind of like a we'll call it the seller's market or buyer's market, I guess, if you will. But right now, there is so little inventory turning because people are staying in their homes, they're not moving. Um, and with such little inventory, those actual homes aren't really, there's not a lot of incentive to like go to an iBuyer, because it's like, well, I'm the only house on inventory. People are going to line up and buy it. So those are the things that I'm going to be intensely watching in 2024 for this company, because I think they're very important for its future profitability and being able to dig out of that hole. I'm not going to say one way or another what I think is going to happen, but those are certainly the challenges, and it's not, doesn't look like the easiest path, I guess, if you will.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.